Hey everyone, and welcome to today's Explainer. We are tackling a massive, fundamental shift today: economic recovery and that inevitable wave that almost always follows right behind it, inflation. Look, when the economic cycle turns, the entire landscape shifts beneath our feet. What worked yesterday, it probably isn't going to protect you tomorrow. So, we're going to visually decode exactly how you can navigate this kind of environment by looking at two absolute pillars of global industry: crude oil and steel.
Okay, let's dive into this, because this is a question that directly impacts every single person watching. Think about your own wealth for a second. When inflation rears its ugly head, the actual purchasing power of your everyday currency just starts to melt away. The cash sitting in your wallet simply buys less at the store. So if fiat currency is actively depreciating during these cycles, where on earth does the smart money go to hide? How do you actually protect your purchasing power when the whole economic environment is running hot?
To figure that out, we've got a four-part agenda to get through. 1. The macro shift. 2. Energy. 3. Steel. And finally, 4. The core logic.
All right, Section 1. Macro shift, recovery, and inflation. Basically, we're exploring the current economic weather.
And that brings us to the absolutely crucial definition you need for this analysis: hard assets. When the economic cycle enters a recovery phase, or when inflation really starts picking up, you need a natural safe haven. Hard assets are physical, tangible things that hold real intrinsic value. Because they're finite, you can't just print more of them, and because they are essential, they become the absolute core focus of the market. They don't just sit there gathering dust, they actively defend your portfolio against currency depreciation.
The fundamental problem we're facing in this macroeconomic climate is super simple. Fiat money loses its value. But that money doesn't just disappear into thin air. It starts moving. It starts running. What we end up with is a massive influx of money desperately chasing real, tangible assets. Based on historical market behavior, the primary targets of this capital flight are energy and basic materials. They are the ultimate real assets.
Moving into Section 2. Energy, the industrial blood. Let's look at how crude oil literally flows through the economy.
Now, what's really interesting about this slide is seeing how a high-level textbook concept like demand recovery actually plays out in the real world. A recovering economy isn't just some abstract line on a chart, right? It's intense physical activity. Factory utilization rates spike. Machines are literally being turned back on. Logistics and transportation networks are totally slammed, with trucks moving goods 24/7. And you see a massive jump in business travel. All of this directly drives huge physical demand for diesel, gasoline, and jet fuel. You cannot fake this demand. It's rigid, and it's absolutely essential for the economy to even function.
But here is where the mechanics of oil get, well, truly fascinating. Crude oil plays this wild dual role in this kind of environment. On the left side, oil is the inflation driver. It's the mother of all commodities, pushing up the cost of manufacturing, shipping, producing, pretty much everything. It causes the inflation. But take a look at the right side. Energy is also the ultimate inflation beneficiary. Because it has this incredible value preservation capability, energy companies can easily just pass those higher upstream costs straight down to the consumer. So for the companies actually pulling the oil out of the ground, this translates into a beautiful dynamic: simultaneous growth in both their top-line revenue and their bottom-line net profit.
Okay, Section 3, Steel, the economic bones. We're building the foundation of recovery here.
Let's walk through how this demand completely explodes, step by step. In Phase 1, the really early stages of a recovery, governments need to jumpstart the economy. How do they do that? They spend money, big money. This acts as the ultimate catalyst, leading directly into Phase 2, massive infrastructure investment. We're talking about colossal projects here, building new bridges, paving highways, upgrading entire power grids. All of that requires literally millions of tons of steel. Then, as that government stimulus circulates, we hit Phase 3, the manufacturing boom. Consumer confidence comes roaring back, and suddenly the auto and machinery sectors heat up, demanding even more steel to build cars and factory equipment. The demand curve just goes absolutely vertical.
And this brilliantly illustrates exactly why investors care so much about steel right now. It's called the ton steel profit spread. Look at that first bar. During a recovery, raw material costs for steelmakers, things like iron ore, yeah, they go up, but only slightly. But look at the second bar. That intense vertical demand gives steel companies immense pricing power, sending the price of finished steel soaring. The difference between those two bars is your third bar, the profit margin. Because the finished product price totally outpaces the raw material cost, the profit for every single ton of steel explodes. This leads to massive gross margin expansion, which, historically speaking, causes steel company stock prices to completely skyrocket.
Bringing us to our final section, Part 4, Core Logic, Hard Assets. Let's bring this whole anatomy together.
Let's break down how this builds a virtually foolproof mechanism for wealth protection. Honestly, whether we're talking about the blood of the economy, crude oil, or the bones, steel, the playbook is exactly the same. Step 1. You establish indispensable rigid demand. The economy literally cannot recover without them. Step 2. Flex that pricing power to pass costs straight through the supply chain. And Step 3. Convert all that macroeconomic heat into cold, hard corporate book profit.
So, the crucial point is summarized perfectly by this quote right here. Economic recovery and inflation are essentially the process of money chasing real assets. It is not an accident that capital flows this way. It's a fundamental law of economic cycles. Energy and basic materials thrive because their physical necessity gives them the superpower to just outrun currency depreciation. They represent an investment opportunity that you simply cannot afford to ignore during this phase of the cycle.
Which brings us to a final, very serious question for you to chew on today. Take a hard look at how you've positioned yourself for the months and years ahead. As inflation acts like a tidal wave crashing against the value of fiat currency, is your portfolio built entirely on fragile paper promises, or is it securely backed by the blood and bones of the real economy? Thank you so much for joining me for this explainer. I really hope this structured look at hard assets has given you a powerful new lens for understanding the financial world around you. Keep learning, stay focused out there, and I'll see you next time.